everyone. Welcome to the KE Report and another daily editorial, this time focusing on the energy sector, oil and natural gas, as we are chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report. That's where Josef dives into individual companies, sharing his analysis and buy targets, buy signals when certain companies reach certain levels. Josef also writes the Eye on Energy Report. This is a free report that really just breaks down the fundamentals around oil and natural gas. Josef, let's quickly start with oil. Price wise, oil's been in a bit of a downtrend. It's now under $70 a barrel. And look, it just continues to be relatively, I guess, range bound, this whole market. But I still think you can make the argument that oil has been in a downtrend here for the last over 2 years, when it peaked at $130 a barrel in 2022. Now it can't really seem to get above $80 a barrel on any rally. What's going on here, Josef? Is this truly a downtrend for oil that could continue?
Well, I think, what I've talked for a while is I thought that when we got up to, $79 in January, because of Biden putting sanctions in on Russian shipping, I thought it was overbought. I had a chart in my presentation at the World Outlook Financial Conference showing that overbought. It's now around the neutral mark with the price of crude at 68.54 right now. I think we're going down below. I've had a range of 66 to 68 for a number of months in the reports for people who've read Eye on Energy. I think it's possible we could go below that. I'm now thinking the low bottom could be between 64 and 67. So I think we're looking at one more down thrust into March. Part of that is going to be we're going to be out past winter. Demand always backs off after winter. So if we see inventories build in the United States and in other places, we could come down a little bit more, but not much lower because we're getting close to the cost of production for many of the major play areas around North America. And so we'll see maybe a slowdown in the US activity. The rig count in the States last week was 592, down from 626 a year ago, down 5.4%. And both oil and gas were down. Gas was down 17.5%, 99 rigs working versus 120. Again, prices where they are justifies not, unless it's a really liquids rich play, not doing anything. And then the other one is oil, 488 rigs, down from 503, down 3%, simply because I think you're seeing the price of oil back off, and everybody's waiting to see the regulations changed, under the new Department of Energy Secretary. Also, they want to see, more approvals of infrastructure, both pipelines for, oil in the two key plays, the Permian and the Eagle Ford, have associated gas. And the pipelines are full right now for both oil and gas. So if you want to add more oil, you need more pipelines to take the gas down to the Gulf Coast for the LNG market. So there's a number of bottlenecks here that we're waiting to see. And there's been already approvals. The energy minister was on TV and he said we already approved one new LNG plant. I've got 12 on my desk to approve, and we're looking at more infrastructure. You also heard, President Trump saying he'd like to see the XL pipeline built again. But of course, TC spun out South Bow with their liquids lines, and South Bow has put out a comment saying they're not interested in doing it. I think everybody realizes the cost after watching TMX, and Coastal realizes that whatever numbers you thought you needed, the numbers just don't work for major projects like this.
Well, I do think there's a need for more infrastructure to get more pipelines to get the gas to the ports. But to the point you just made about U.S. rig counts being down for both oil and gas, that's not true in Canada. They're actually up in Canada, and it's not true globally. There's a lot of countries that are still looking at ramping up production. So when we widen our scope out, Joseph, you'd brought up Iraq as a potential player. But what's going on with OPEC? What's going on with Canada? What's going on in the global scene as far as supply?
Well, Canada's supply, we're looking at about 6 million barrels a day this year. We export about 4.5, of which maybe 3 plus is heavy oil, which goes to the refineries in the Midwest and the Gulf Coast. So all of that is good. Trump's comments that we don't need Canadian oil, I think, is garbage. Those refineries can't convert to do light oil. Tens of billions that will have to be spent to do it. And Mexico can't increase their heavy oil production to handle it. The only one that could shaft the Canadian heavy oil industry and our markets in the States would be if there was a change in government in Venezuela and the American companies that had all their assets nationalized, except for Chevron, which has been increasing production. And Venezuela now produces 1 million barrels, of which 280,000 are Chevron. They bring in the diluent and then they bring it out. Potentially, Venezuela could do 3-4 million barrels if everything was open and the doors were open, change in government. But again, there's a lot of infrastructure rebuild that has to occur. But if you remember Kuwait, after everything was destroyed by Saddam Hussein forces as they withdrew, things like that can be repaired in a year or so if there's a will and the money is there. And again, I would not doubt that American companies, if they got the business argument in favor, that they would go back in and we would see something happen quickly. That's the negative wild card for oil in general in terms of higher prices, 90, 100, and that's the negative case for Canada. But I think given what we know about what's going on in Venezuela, I don't think there's going to be a change in regime. And Trump is more focused on Iran than he is on Venezuela.
So the big question is what spurs that oil production growth? And we can always go to price, higher prices, entice more companies to bring more wells online, to drill more wells. But what about at this current pricing level? Let's just say between $65 a barrel and $80 a barrel in US dollars. Is that a good enough price level, just broadly, for companies globally, that's the important part, globally, to be increasing production?
We know about Guyana. We know that's going to come on. ExxonMobil's behind it, and we're looking at hundreds of thousands of barrels a day with monster wells. So the economics are there at $50 or less. So they're going to bring that on. We know that there's activity going on in Brazil to bring on more production. There's going to be about 200,000 barrels coming on in Canada because remember, if you're getting $68, multiply that by 1.43 for the Canadian dollar, and the oil companies will tell you, yeah, that's why we're drilling more because of weaker Canadian dollar. And if Trump puts the tariffs on, then two things could happen. One, WCS differentials could widen from $14 to 16 or 17, and then the second thing would be a weaker Canadian dollar from 70 cents to 68 or 66. That's why I think any tariffs that come in are not going to really be painful for the energy sector, but for most other sectors, the 25% on steel and aluminum and forest products, even with a weaker Canadian dollar, they're going to have more challenge than the oil and gas industry with a 10% tariff.
Well, Joseph, let's also talk nat gas. Nat gas has been holding up pretty good, close to the $4 area. There's a lot of talk about the LNG terminals, as you mentioned, but dig in a little bit deeper on the supply demand. We're also getting near that time period where we're going to have to start restocking, and we're kind of at lower levels.
Yeah, the storage levels in the States we're looking at, last week down 196 BCF. The biggest portion of the decline in the Midwest, 65 BCF. The East lost 49 BCF. And so we're now 15.5% lower storage than a year ago. And we still have, until April 1st. So if there's one more cold spell, we could end up at 1.6, 1.7 TCF. And the industry is going to want to fill it up so they'll be ready. A lot of the weather forecasters are saying we may have a very hot summer, which means more air conditioning demand, which means more natural gas for electricity generation or, for air conditioning. And then you've got the fact that we've gone from 14 BCF to a high this last week of 16.5 BCF of LNG exports. And the Pascualis new facility is producing, I think, 1.3 BCF. Its capacity is 3.2, so it's ramping up. And so we're going to have 18, 19 BCF exports there. This morning, I saw a release by Petronas, which is one of the partners in LNG Canada, And they're saying in that press release they will have their first export cargo in July. So that means 2 BCF almost on a regular basis is going to go to the West, which is not going to be able to go into storage, which is not going to be able to be available, which tightens things up in Western Canada. We're about 250, 260 for AECO right now. Not a great price. At the end of winter, it was, I think we've had higher prices, $3, $4 when the real cold weather was on. But I think that heading into July, August, after the first LNG cargoes go west, I think we're looking at $3 gas, and maybe next winter, $3.50, $4 gas for, Station 2 and AECO. That would be a very good price for the industry.
Is there a lot of low-hanging fruit out there in terms of easy and quick to bring on natural gas production in North America, considering it is sometimes a byproduct to a lot of ongoing production anyway?
Yeah, if you're drilling for condensate, liquids rich like, Whitecap and tourmaline and, all the ones that are focused on, that are focused on liquids rich natural gas, New Vista, other names, Paramount, then they're gonna focus because of the liquids. The gas is not that important. But if you have higher gas prices, a lot of companies have facilities where they're not maxed out. And if they could increase, for example, in Birchcliff's case, they're producing 74,000 BOEs a day, but they have 87,000 BOEs a day of capacity at Pouce Coupe and Gordondale, which they mentioned at the conference. So they could ramp up quicker if the market was there and fill that capacity. And then long term, they have the Elmworth project, which could, easily be another big significant portion. The first phase of which would be the equivalent of 80 million a day, or, in which would be 12, 13,000 BOEs a day and take the company over 100,000 BOEs a day. So there's a lot of companies out there, Advantage, others that have facilities that are not at capacity. That's really the potential upside for the industry. Is the more gas you have running and you run your facility, there's going to be maintenance periods, so you can't run at 100%. But as close as you can get to 100%, your op costs become very low per unit, and that's where the profitability really takes off.
Yeah, Joseph, I had a good discussion with Birchcliff at that show, at the World Outlook show, and they said if it goes from 250 to 350, it suddenly has their attention, and if it gets, if it's sticky and it stays there in the mid threes, they could definitely ramp up. And I think that's the case with a lot of companies. With that in mind, are you more interested in the leverage that some of these nat gas companies could offer compared to maybe a sluggish oil price, or are you still seeing opportunities in both?
I'm seeing opportunities in both. Like if you look at the stocks, many of them are trading very close to 52-week lows. I can give you a couple of examples, which is the old Crescent Point, is trading at 691. The high for the year was 1267, the low 634. So you can clearly see that one has come back off. You look at other names, New Vista, 1206, 1486 high, 1034 low, not as big a swing there, but there's quite a few names where you're seeing here's Bonterra, which is an oil name, 687 high, 366 now, 52-week low, 310. So, and then Birchcliff, we've talked about, 654 high, 551 now, 452 low. So a little tighter range there, but there are quite a few that there's a big swing. And I think that's where you're going to see, quite a bit of upside if you're patient. Vermilion, for example, 1211 now, 1756, 52-week high, 1184 low. So I've given you examples of oil and natural gas that are very cheap. I'll give you one more, Whitecap, which has got a 10% yield, 1131, 52-week high, 981 now, 886 low. So there's a lot of upside potential here on both sides, and that's why I'm recommending people have both exposure to oil, natural gas, and to the service sector, because I think all of them, and then also consider domestic names and international names. Some of the international names are trading at bargain levels.
So is this a here and now that you think people should be buying these stocks, or is it a waiting game? Or even on the flip side of that, if you do want to buy now, buy the higher dividend stocks so that you're paid to wait?
If you feel like you need to go now, the dividend yielding stocks have less downside because many of them are yielding 8, 9% right now. And there's many cases where they're very well covered, a surge being an example, well covered, Petrus well covered. So you can get a good yield while you're waiting, hemisphere while you're waiting. And then my view is that March is going to be a difficult month with the lower price, I think, for oil. I think there's a general stock market weakness coming. We're seeing, everything from Bitcoin come down, Tesla getting murdered, Meta's getting hit. If Nvidia says that the outlook is disappointing, the numbers for the quarter should be good that are released tonight. But if the outlook is a little bit disconcerting because of DeepSeek, the China alternative, then I think you're going to see that correction that I'm looking for. Price of oil down, 64, 65, 66. The TSX oil and gas index, which is now 261, between 230, 240. And if that happens, that would be my buy window. We would then send out an action alert buy. I'd likely have 4 or 5 new names to say we're adding to our buy list. And we think that, this could be a low, and then we could see a significant move into the end of the year. I think it is highly likely that if we have $90 oil, that a large number of names that we cover could see 50% upsides between now or between March's lows and the end of the year.
All right, so looking at some of those lower prices in oil and possibly some equity weakness across the board to get into position and then ride it back up. If you see oil go from 64 to 66 up to 90 again, that'd be a nice run for the sector. You brought up oil services, though, and I think it'd be nice to dig into that. Anything you see on the drilling or pipeline side that has your interest?
Well, the drillers have backed off. You look at Precision Drilling, it was a $109 stock. It's now 73.11. The low for the year was 73. So, Precision's getting hit here. Step, 526 high, 446 now, 337 low. So it's not much of a discount there. And then if you go to Total Energy, 1042, 1244 high, 888. And the last one would be Trican, 450, 545 high, 399 low. And they've shrunk their capitalization by over 40% with their normal course issuer bids, and they're very active on it. And plus there's a modest dividend. So, there's enough names out there to be looked at. And, I own a number of names, or at least, one name for sure. Yeah, one name in the sector. And, I'm looking to add to maybe one more name or add to my position that I own right now.
How about the really small stocks then, Joseph? You going down into any of these much smaller market cap stocks, or do you see an opportunity in those?
Well, a lot of the smaller caps, if you're looking at some of the names that we cover, you've got some, although Petro yields 10%, if you want to go into driller, Ensign's a good name. You've got a 5.3% yield in Hemisphere, 10% yield in Play, 8.8% yield in Petrus. So for people who want to go into those kinds of names, we really focus on some of the ones where we see significant upside in the production side. And the name we've talked about before, Touchstone Exploration, which was at the conference as well, their production is going to go from 5,000 BOEs a day to likely north of 10,000 by the end of the year, and potentially next year to 15,000 BOEs a day or more. So there's those kinds of companies which are getting infrastructure. They have an acquisition they're getting from Shell, and then they do drilling to replace declines and drilling to grow production. And they've got pipeline facilities that can grow significantly those numbers. We like that one, but that's a more junior speculative play that's on our recommended list, and which I own as well.
One more thing we maybe should bring up is M&A. We've seen some acquisitions by company adding to their land package, but do you think with the lower prices that it may move some companies off their stumbling block? Because at the higher prices, a lot of companies just wanted too much for their projects. Now, if we see a lower price in March, could that spur on some M&A?
I think if there's bank nervousness, as we've seen in prior cycles when price of oil goes down, they kind of want companies to slow drilling down, make sure the interest coverage is there. And so, I don't know if there's a number 64, 63, we're 68.52 now. is there a number that the banks get nervous and say, slow down, and if the price goes up and later in the year, spend your money then. And again, we're going into breakup, so people stop spending anyway. Within a few weeks, if you look outside here in Calgary, there's not much snow on the ground, so we could see an early breakup as well, and that would mean less drilling. So I'll be watching the weekly Baker Hughes data to see if that's the case. But I think that when we get into Q3 and we have these stronger commodity prices, I think we're going to see more M&A. We saw, Vermilion take out a Westgate. We've seen InPlay do a deal with Obsidian. So again, if there's strategic reasons, Obsidian wanted to get rid of its debt. Cardium for them was an originally core stable asset, but InPlay wants to consolidate the play because they have assets very close to next door to the ones they're buying, and they can see synergies operationally to lower costs. So if there's a deal that can be done for both the buyer and the seller's interest, then you can do it. And in the case of Vermilion, they just want to get bigger in the Montney, and they were able to do a deal at a price that made sense for the vendor and for them. So, I think that if you want to do a deal in Saskatchewan for light oil, I think there's a discrepancy between buyer and seller, and that's why we haven't seen many deals there, because the vendors see the price in Canadian dollar terms and they want to get paid for it, and the buyers, don't see the numbers making sense at this point.
Just a quick comment on that deal that you were just mentioning there, that InPlay Oil, taking some of those assets from Obsidian Energy. We've had InPlay on the show a couple of times. This is a pretty significant deal for InPlay Oil. Do you think this is a good deal that they just did? And if you do, when could the market react to it?
Well, if you look at InPlay's market cap before this deal, it was $162 million. This deal is a $300 million. So it's a very transformational deal. And we're going to cover that in our webinar tomorrow night. We have our quarterly webinar for subscribers tomorrow night at 7 p.m. And one part of that will be the InPlay Obsidian deal. And I think that the key is going to be, can they show the efficiencies and can they pay down? They talk about free cash flow at $70 WTI. And if they can pay down debt as quickly as people are expecting, the one wild card is Obsidian is getting shares, and people are going to be wondering, is that an overhang on the stock? The hold period is not that long. They could spin it out to the shareholders of Obsidian, the shares they're getting in InPlay, or they could sell them at a later date. That overhang, hopefully gets taken care of, and I think the market will hold the stock back. But once that clears and they can show the big bump up, like the dividend is 3 times covered under this deal, so they don't see a problem with it, then you could see the stock react. So it's a second half of 2025 story in my book.
Okay, perfect. Joseph, always fascinating hearing how you're viewing the energy markets in Canada mostly, but also in the US and globally. Again, Josef Schachter. Joseph is the founder and editor of the Schachter Energy Report. You can click the link in the show notes to visit the website and learn more about his coverage of the energy space. Always great having you on the show, Joseph. I hope you have a great rest of your week.
One more thing for me, if we can do that. We've extended our World Outlook Financial Conference offer to the end of February, which is, of course, coming up. So if anybody wants to subscribe and take advantage of the $100 off the annual, $50 on the quarterly, our Ion Energy that came out today has all the codes for taking advantage of the promo code, which you plug in at the end when you check out, and you can save a little money. And also, you could be on the webinar, which I think is going to be very valuable.
Okay, I'll post those promo codes in the show notes as well. Joseph, great rest of the week for you.
My pleasure. Thanks very much, Corin.